Welcome back to the Pragmatic Investor, everyone. I am your host, James Ford, and I am joined today by Thomas, ex-ETF wholesaler turned Substack newsletter writer from Investor Snippets. Thomas, thank you so much for coming on.
Thank you for having me.
All right, so I wanted to start a little bit with if you could please tell us a bit about your background. I'm quite interested to understand a little bit better what an ETF wholesaler is, and I'd just love to know your journey a little bit in the financial sector and how you basically wound up just writing this newsletter.
Sure. I'll just briefly start with my newsletter and how I kind of got into it. So right now, I'm writing a daily newsletter called Investor Snippets. So essentially, what it is really just uh, brief summaries and snippets, as the name suggests,
Mhm.
of different stories around markets, stocks, ETFs. The whole point is just something that's like less than 3 minutes. So for readers just to keep up with what's going on in the markets on a daily basis. So how I came across this idea, or how I even started this newsletter, was based on my history and my background as an ETF wholesaler, as you mentioned at the beginning. So I was previously an ETF wholesaler for about 7 years at a US based ETF provider called First Trust Portfolios. And for some of the audience out there, they're not too familiar with what ETF wholesalers do. I always use this analogy when I explain to people that's outside the industry, which is think of pharmaceutical reps, but this is
Mhm.
for the fund industry. Essentially, so what I do there is I promote ETFs, in-house products, to financial advisors, portfolio managers, and
Mhm.
family offices,
Okay.
and really just to get an understanding of their portfolios and try to essentially just to see where our products can fit in their business and their portfolios. So
Mhm.
I came across this idea because on a daily basis I look for sound bites when I talk to advisors and portfolio managers every day. I skim through a lot of headlines, go in, have to know what's going on in the markets. And one day a friend of mine was asking me, he's like, you know what, like, why don't you put together some of the stuff that you read, just snippets, put it down in bite-sized news, and then just share it with people. Maybe someone would actually appreciate it and find it useful. So I that's when I first came across think about starting a newsletter at that time. So I was like, well, I'm gonna read through all the information every day, so why not put it together and just try starting a newsletter and see if someone would be interested. And that's how I initially started with investor snippets.
Mhm. Absolutely, and I've become a recent subscriber, and I can verify that very useful. Obviously a lot of information out there, and it's very good to get a nice condensed table view of that. So I'd like to understand maybe a little bit better exactly maybe what was your day like as an ETF wholesaler, just to get a little bit more background on there.
Sure. Yeah. Day to day usually involves really well. One, I have to keep up with what's going on in the markets, what's hot, what's
Hmm.
not, and two is really just arranging booking meetings with advisors. So each wholesaler gets a given territory, similar to a pharmaceutical rep, right?
Hmm.
So within your territory, you're really just arranging your week to week in terms of which area, which cities you're going to be traveling, and try to stack up meetings throughout the day. You're usually looking at 6 to 7 meetings a day,
Hmm.
and really just each day you really just kind of split between booking meetings and also attending the meetings and keeping up with in terms of how the meetings went or some of the notes with advisors and also, I would say if I had to break it down, so say 1/3 of the time is really booking meetings, the other third is really um, organizing your notes in terms of because every advisor is different in terms of how they run their portfolios, what they like, what they don't like, especially from an ETF point of view. Not all of them use ETFs the same way. Like some of them
Hmm.
really use it as their core in their business, and some they really just kind of sprinkle around as a satellite. So it's really just to kind of um, kind of organized in terms of like how to segment your clients, your advisors, and whatnot. And then the other third of the time, it's really just really attending a meeting and then building relationships and doing a lot of events, similar
Hmm.
to a lot of sales job in different industry. Really,
Right.
just building that relationship.
Hmm. Absolutely. And just to get a little bit of an understanding of your background, then, do you have a finance background? Is that how you got into it, or is it something maybe you just fell into a bit more? randomly?
Sure, sure. I actually have a pretty interesting story to share here. So, I study financial services management
Hmm.
in university here, and when I graduated, I didn't know what wholesalers, ETF wholesalers are or fund wholesalers are because to a lot of people in the general public, they really don't know this role exists.
Hmm.
So I first actually got in as a sales associate for an advisory team that here in I'm based in Canada here in downtown Toronto, and I was working for that team for about a year as an associate. It's really just cold calling, just like into the Wall Streets or Wolf of Wall Streets, like the movies. You're really just pounding a phone, cold calling every single day, trying to prospect. And as I kind of got in that role later on, I kind of got involved with helping the team with managing their portfolios, their clients. And then that's when I kind of came in contact with a lot of wholesalers coming in, trying to conduct meetings, presentations, and whatnot. And I still remember around that time, I was in my early 20s at that time.
Hmm.
And I was given a path like I could pursue keep on working with that team and with a branch manager at the time. He actually offered, why don't you? I mean, you could try start building a book yourself. And it's gonna be hard, and I know how hard it could be because I was actually the one that's doing a lot of cold calling, trying to prospect, trying to bring in the
Hmm.
clients. So I was talking to the advisor I was working with at the time, and he was like, "Hey, Tom, why don't you try doing a meeting yourself?" Because usually I go with him, and then he's the one that's kind of closing. And then I was like, "Sure, I'll try doing it myself and see what's it like if I actually try to close a client myself or actually try to build a book myself." So I still remember I went to my first meeting, and the guy looked at me. I still remember opening the door. He looked at me up and down, and he's like shaking his head. He's like, "Okay, come on in." And I know the next hour or so, whatever I talked about, he had no interest. And the reason,
Hmm.
because I look too young, and I am too
Hmm.
young. And then
Hmm.
in the retail side, what I've noticed at a time is, like a little bit of gray, a little bit of age speaks a
Hmm.
lot. Like no
Right.
one's gonna, especially we're talking about like high net worth individuals, they're not gonna trust anyone with their money if they look too young, too inexperienced with the markets, or at least look like they don't know, or they're just fresh out of school, right? So, at that time, I was telling myself, okay, no way I'm going to be building a book at that age. It's not something that I could work out at that time. I mean, I
Hmm.
could try and force it to happen, but it's going to be very difficult. So, that's when I started seeing all these wholesalers coming. I was like, well, hey, maybe that's something I can pursue because, I'm still in this industry. I'm still in sales, but, I'm kind of more, less on the retail side, and your age is not going to matter as much. And
Hmm.
that's how I kind of got into the wholesaling side of the industry.
Hmm. It's very interesting. You talk about the cold calling, and I kind of picture Leonardo DiCaprio in The Wolf of Wall Street. Kind of
Right, right, right.
in
No,
the.
pretty much. They actually, so here's something shocking. So when I got in that industry, when I was cold calling, it was in 2010, I think 2010 or 2009, somewhere there. And they actually still have like a boiler room, like a boilers room where actually you
Right.
see like 8 to 10 people in a room. They're just pounding the phone, calling, calling, calling. And it's shocking because I actually didn't know until 1 month in. Apparently everyone's calling the same list. So all these like brokers, they actually get the same list. You just buy off a list of all
Right.
these like CEOs, executives, doctors that they actually buy a list from the phone company, and we're talking about like maybe like 3 or 4 thousand names, and you have 8 or 10 cold callers. They're kind of just recycling the same list again and
Mm.
again and again. And I was like, well, no wonder these guys are all pissed off when you call them. They get like
Right.
at least like 8 calls from, the maybe from like different rep or different cold caller,
Hmm.
but get like 8 different calls about the same thing every single week.
Hmm. Yeah, I can imagine how that would get annoying. I don't know. Maybe at some point there'll be a better way of doing it. AI will probably take care
That
of
I'm pretty sure AI is gonna automate that for sure.
it. Awesome. And just to be clear, so you've stopped doing that, and now you're doing the investor snippets full time. Is that right?
Yeah, I've been doing this full time since last year.
Awesome. Now, I'd like to get a little bit of insight into how you think about investing as someone who's kind of been on the inside. Yeah, just how do you think about managing your own money? I mean, obviously, you dealt with ETFs. ETFs, for example, a vehicle that you use. Do you like to pick your own stocks? What's your approach?
Sure. So for me, I'm actually very boring.
Hmm.
I just hold a couple of ETFs, a couple of stocks. That's it. It's actually very boring, very simple. And also, this is something that I learned later on when I
Hmm.
got into industry. Because prior to industry, I was like looking, I was like, wow, people that work on the inside, like institutional traders and whatnot, they must have a very sophisticated portfolios. But actually, a lot of guys I talk to, their own personal portfolio is actually very plain and simple. It's really
Hmm.
just like maybe one or two like broad-based equity ETFs,
Hmm.
something that's like one niche ETFs on the side, and a couple of good like blue chip stocks. That's it. It's actually pretty boring. I mean, uh,
Hmm.
that's a interesting thing about being a ETF wholesaler because you actually talk to so many financial advisors and portfolio managers across the
Hmm.
country, or at least within my territory, and you get to see how they all run their portfolios, and it's eye opening to see that a lot of times, yeah, sure, the way they run the portfolio is different, but it's actually not as complex as you think, and
Hmm.
it's really at the end of the day, and this is just my personal investing philosophy right now too, which
Hmm.
is I'm pretty sure like a lot of people heard this before. Don't time the market.
Right.
Sure, I keep up with the news. I keep up with what's going on with the market, on a day to day basis. But maybe you make some adjustment to your portfolios, your holdings, and whatnot. But in terms of like
Hmm.
timing it, like right now, for example, I'll just use right now. Everyone's talking about rest of this year. Now, S&P is up 14, 15%. Same thing with NASDAQ is up over 30% already.
Hmm.
Past couple of days, it's been coming back down, and everyone's talking about, oh, it's recession coming because everyone's been calling recession for the longest time. It's not coming, defying it.
Hmm.
Now they're like, well, it looks like it might be coming soon. Is it end of this year? Is it early next year? No one
Hmm.
knows. And you start seeing a lot of people in terms of like at least you see ETF flows, like a lot of people kind of floating out of equity into equity, fixed income and whatnot. But myself, in terms of investing philosophy, I believe is really just instead of timing the market, is really just looking at the long term. It's really
Hmm.
just having your portfolio adjust in terms of what is your ideal target
Hmm.
is for the year. And this sounds like pretty old school, but a lot of advisors like that's kind of how they pitch their clients too, which is you look at the next 20 years. Your goal is, I don't know, like 8% a year, 9% a year. So your plan is really just to adjust your portfolio to ensure that you actually have that rate of return every single year, and you're good to
Hmm.
go, right? That's really exactly what you're looking for. So, example like this year, the market is up already, and for those that are scared, then you can scale back and hedge your risk, and you can kind of move out of equities, kind of hedge your side, but I'm really I'm really in terms of because I see a lot of people kind of jumping in and out, in and out, in and out.
Hmm.
So my philosophy is really just very simple. It just yeah, keep it simple, keep it allocated. Just make sure you just stick to the plan that you had initially. That's all.
Hmm. Absolutely. That that makes a lot of sense. Kind of the way I see things as well. You need to prepare for the long term. Within that, of course, maybe there's certain sectors that
Right.
you think could perform better over the next 20 years. I know, for example, certain countries I think might perform better, which might tilt my portfolio a little bit. And then within that, you can do trades, but you gotta
Exactly.
know that what you're doing to that extent. Know that you're kind of just playing with fire a little bit. It's not
Sure.
quite so much investing. Now, um, so I wanted to obviously you have the pulse on the market because you follow it every day. So I wanted to get your thoughts on some of the recent news. And in fact, I'm just looking here at your latest investor snippet. So maybe kind of go through a couple of the headlines and just gauge where you stand on some of these issues of the day. So, for example, I see here in one of in your last email, Fed officials see upside risk to inflation, possibly leading to more rate hikes. What do you think about the current outlook for inflation and what the Fed is doing with rates at the moment? Any thoughts there?
Uh, my personal opinion. Okay, in terms of rate hikes, I don't think there's going to be more to come. I mean, there's a lot of anticipation that, because of the Fed minutes yesterday, it looks like the Fed is going to hike the rates even more because of how resilient the economy has been.
Hmm.
Personally, I think even if they do, at most, it's just going to be one more, because this is just based on what they've been saying
Hmm.
in the past couple of months. They said this was 2 months ago, back in I think early June, where they anticipate two more rate hikes this year. They already did one last month, so potentially one more to come at most. Um, However, I really don't see. So in terms of inflation, so this is just my personal opinion. So the Fed's been so focused on getting back to that 2% target, but
Hmm.
right now it's already at 3%. Like I think it's like 3.2 on a yearly basis in July.
Hmm.
Um, and from a very simple point of view, if the overall inflation is at 3%, the economy is still resilient, retail sales is still up, job growth is still great, employment rate is still low. Isn't this like the most ideal situation already? Like,
Right.
historically speaking, right? I mean, historically
Hmm.
speaking, inflation average is about 3% a year. So ideally, the current situation right now is actually pretty ideal already, right? So
Hmm.
that's why I personally think being too concerned or too obsessed with getting that 2% inflation target, it might be a little bit too over the edge. That's just me.
Hmm. Yeah, absolutely. I share a similar take for sure. I mean, I think that the Fed could be at risk of over tightening, and we have to think that the monetary policy has a lag effect. So we're only now going to start feeling the effects of monetary
Right.
policy just about now. So now is when the economy might start weakening, and might actually Fed might be at the risk of over tightening. Then, like you say, we're pretty much at the objective there. I mean, could inflation come spiral back out of control? Well, there's some issue. Obviously, commodities have gone up a lot, but it seems a bit. I mean, I've talked about sticky. At most, I would say there's maybe sticky disinflation where we don't quite come down to 2% so fast. But like you say, what's the worst that could happen there, right?
Right. I agree 100%. So
Hmm.
like, why push it more when everything's looking great right now? I mean, especially the biggest recession concern that everyone's been talking about right now.
Right.
Well, especially the trends. It's been changed from last year. They say, oh, rate hikes, like GDP is going to drop, sales going to drop,
Hmm.
job growth, everything's going to drop, right? And this year everything's been great, and there's still going to be voice that's saying, oh, recession is still coming. Why? Because you don't know when the economy is going to feel the full impact of the rate hikes, right?
Hmm.
That's been going on in the past year. So
Right.
now everything is actually looking good. So this, why not? Why push it more? Why push it more to see? Hey, let's see how much more the economy can take before it starts collapsing, right?
Hmm. Yeah, absolutely. It's interesting. Like you said, it seems like sentiment is always a little bit behind. I mean, looking back a couple of weeks ago, everyone was already so hyped up on the market that this sell-off kind of seemed predictable looking back. But it's interesting. I was actually listening to another podcast, and I can't remember who it was. Anyway, they mentioned, for example, you look back at 2007, and actually, even though like that period 2008, we now consider a recession. You actually look, for example, at the second quarter. Then GDP was going up, kind of like now 2.3%. So, kind of that idea that even though the data right now is very strong, we could technically already be in a recession, which we will
Right,
find out later, right? Without knowing already
right,
to that extent, kind of, and tying this in with the next headline which you had, which was talking about the 1 trillion in US credit card debt, and that is kind of, and I've seen kind of differing information on this and I can't quite get a grasp because you see charts like that. Obviously, debt's very high, mortgage rates are really high up, but then at the same time, I've seen some charts that suggest that some stuff like excess savings is going to run out, headlines like that. But then other ideas that saying actually no, households have a lot of cash. Yeah, how do you feel about that? The idea of all the debt that's going around and the general health of the U.S. household, let's say.
Honestly, personally, I don't have too big of an opinion on this. The reason I actually shared that article because I've been
Mhm.
seeing a lot of bearish news in terms of at least this whole sentiment, right? In terms of like you know, sure, there's the economic data that's been looking great in the past,
Mhm.
couple of months. But there's also the other side of the story where they say, oh, well, look at the debt level has been, going up every single day. And, that's why we're going to see a recession. And the main reason I just want to share that article is just to show like, well, there's always two sides to a story, like whatever, you know, like debt, for example, like credit card debts in general. Like a lot of people say, well, it's bad. Look, it's reaching record high again, and again, and again, and again. But at the same time, if you think about it, well, yeah, it is, and it's still not collapsing. At least at this point, I don't know,
Mhm.
what's going to happen a year from now, or maybe even later this year. But at least at this point, they've been saying debt's been racking up every single month this year, and it still hasn't collapsed. Why? Well, I saw that article is pretty interesting, which is, well, income has been going up, right? Assets is still going up. And
Mhm.
what's interesting, which was not mentioned in that article, which is something I saw a couple of weeks ago, on at the same time when all these debts are at record high, what else is at record high? Which is assets in money market funds.
Mhm.
So that's actually been getting at a record high level. Like
Mhm.
I've been seeing on headlines when debts are reaching record high. Same thing with money market funds, right? So if that's the case, so where's the money coming from, right? Like so those money is still stacking up. So in that sense, like following that article, for people that didn't read that article or are not familiar with the angle they're putting in, which is where sure debt level is getting high, but so is income or assets level. That's kind of blending in. So that's why you haven't seen like all these debts collapsing yet because people
Mhm.
are still having enough assets and income on that level. But in the long term, is that going to be a problem? Probably. But at least for the time being, if there's still assets and income in the whole economy that's kind of circling around,
Mhm.
then I really don't see that as a big issue in the near term. And that's
Right.
just my personal opinion.
Yeah. Absolutely. I mean, at the end of the day, 1 trillion is just a number. What really we should
Exactly.
be interested in is like the proportion, right? Yeah, okay, but we have to put things into context, right? I mean, we've been printing money the last few years, we've been giving money away, and all that's also in the economy, right? So there's a lot of cash, asset values. So in proportion, if you look at the, let's say maybe the financial ratios actually don't look quite as bad as that headline number of a trillion, which is still a lot.
It's still
Uh,
it's still a lot, but yeah, like I said, it's like, at the end of the day, is it's just a number. So
mhm,
and this is just one thing I also learned from writing my newsletter, Investor Snippets, which is, you know, and this is how I kind of created the articles that's in my newsletter, which is a lot of these medias, their headlines. I mean, they're just there to kind of get attention, right? And I'm pretty sure you
mhm,
notice it too. Like all of these headlines, they I wouldn't say they exaggerate, but they purposely use like certain words just to make it way more appealing just to get the attention. And then that's why $1 trillion, yeah, that's a lot. But at the end of the day, it's really just a number at the same time, right? So
right, absolutely, yes. I know that very well. I mean, I write articles for Seeking Alpha, and obviously, getting
right,
getting people to engage is important, and some certain titles might do that a bit better. Um,
right.
Speaking of headlines, the next one I want to talk about quite interesting because kind of a sell the news, if you will, because uh, we saw that Coinbase recently got approval to offer crypto futures trading in the US. And as we talk about this, I mean, I just saw this, before I logged on. I was on the road, and we've had huge moves in crypto, Bitcoin and Ethereum down 6-7%. Now I know you mentioned, you don't follow crypto too much, but I know I'd love to hear your thoughts at the very least on Bitcoin and Ethereum. Is it something that's even worth owning just for diversification purposes?
Yeah. Personally, crypto wise, I don't personally, I'm not a huge fan of a lot of the altcoins
Hmm.
myself. In terms of Bitcoin, Ethereum, for sure. I tell even people around me, um, if you can even squeeze out like a small allocation, just invest a little bit in it. You don't know. I mean, the way I see it is, I mean, I've heard so many side of an argument like why crypto is great and why crypto is not going anywhere. But at the end of the day, there's still a huge demand for it. And I've been seeing, the reason I believe in the long term, it's crypto is here to stay. I personally think so. Like digital currency is here to stay. And if they're going to stay, like usually the biggest like market movers right now, which is like Bitcoin and Ethereum, chances are they're going to stay with it. Now, there's like thousands of altcoins out there. Are they
Hmm.
going to still be around like, I don't know, like 5 years, 6 years, 7 years later? God knows, right? But
Hmm.
then, the major ones, Bitcoin, Ethereum, yes, 100%. I personally have a little bit of money invested in it too. And I personally think that it's really going to here to stay because I'm seeing it like that's when I noticed what happened was I noticed a lot of banks and institutions start taking it seriously. So I don't know if you saw this. So BlackRock, they've already been expanding into the crypto space themselves. Not specifically, well, they did file for a Bitcoin ETF per se, like actually spot Bitcoin ETF. But
Hmm.
in institutional level, they already have like their own set of team where they service institutional clients in terms of investing in the crypto space or specifically in digital currencies and whatnot. And they're not the only one. I've seen a lot of banks in Canada and US across like North America. They're slowly adapting and moving towards this space. And same thing with even like some pensions out there that I've seen. And when you have all these massive institutional channels, it's kind of getting themselves involved in this space. That's
Hmm.
when it somehow is going to stay. And the reason I say why it's going to stay because they're going to have all these like massive assets from that level. That's kind of keep on pushing this market higher and higher and higher. So to wrap it up, yeah, personally, I think digital currency it's here to stay, and then Bitcoin, Ethereum short term, who knows, right? Like, you can drop like 15-20%, and then a week later or a month later is back to the same level. But point is, in the long term, I think that it's a worthwhile investment to kind of have in your portfolio.
Hmm. Absolutely. Well summarized. And just to get an idea, then, would you subscribe to the idea of Bitcoin kind of being like digital gold?
Sure, yeah, I would. I mean, at the end of the day, I'm not going to get into too much detail about the history of gold and gold standard and whatnot, but
Hmm.
in a very basic concept of what gold is really just a storage of value that a lot of
Hmm.
people believed in since long, long, long time ago, right? They just believed in it. There's enough people believe in gold, and that's why the value still holds there, and then it's still today is still there, right?
Hmm.
If you apply the same concept to Bitcoin, it is a digital version, like a digital version of gold, which is there's that belief that the value is still there by there's enough demand that believe the value is in Bitcoin. So in that sense, then yeah, it is equivalent of a today's day of a digital version of gold. I personally believe that. Yeah.
Hmm. Absolutely. Yeah. Definitely on the same page there. Big proponent of gold myself. I'd happily call myself a bit of a gold bug. Now, the next headline you bring up, of course, this has been the topic of the year, which is AI. And you mentioned in your latest newsletter that NVIDIA is going to be reporting earnings soon, next Wednesday. So, yeah, kind of thoughts on AI. I mean, have we run too far? Is this crazy? This kind of a ride we've seen in AI, or are we just the beginning? Is this the dot-com crash, or are we riding the next wave up?
Right. So the way I like to see it is, I mean, a lot of people like to compare like AI, like you said, to the dot com bubble back in the late 90s.
Hmm.
Um, I okay. So if you even look at a dot com bubble, like sure it did crash, but the whole concept of like of internet and web page and websites and that generation of technology,
Hmm.
sure it did collapse, but in the long run, look what happened, right? Like tech
Right.
actually took over, especially internet. you know, um, this is actually like kind of off track, but there's actually an internet ETF when I was working as an ETF wholesaler, where I think from the mid 2000s up to like I think 2018, it was literally the best returned ETF ever because the internet space itself just skyrocketed, right? So back to dot-com bubble, sure, it collapsed big time, right? But then look at the 20 years afterwards, right? It did phenomenal. It's great because why? It's here to stay. So AI, I don't have a crystal ball. I don't know what's going to happen. It
Mhm.
might crash this year for all we know because everyone talk about AI, ChatGPT, and whatnot, and it might actually be a bubble that's going to pop this year, next year, who knows? But in the long term, I believe this is like this is one of those technologies that's here to stay for sure, right?
Mhm.
So from an investing point of view, like just like what I mentioned earlier, if you believe this is gonna be something here to stay in the long term, then it's
Mhm.
worthwhile to kind of invest or have money in. So
Mhm.
same thing with AI. So in the long term, I'm pretty confident it's here to stay, and the world is going to adapt to it somehow. I mean, you can apply
Mhm.
to multiple places, multiple industries, so it's going to be here to stay. The question is, how bumpy is the ride going to be as it goes up?
Right.
Right. So yeah, my personal view on AI is long term, it's gonna be great. Short term, I don't know. It might be a little bumpy ride. It might actually a crash here and there,
Mhm.
whatnot. But over long term, it should be fine.
Yeah, absolutely. I think a lot of people, at least myself, see it in a similar way. I don't know if you're familiar with this thing called the Gardner hype cycle,
Right.
which
Right. Yeah.
basically kind of defines that idea, right? That everyone is now kind of at the peak of expectations, and we're all kind of as investors trying to predict what the AI is going to do, but reality isn't quite there yet, right? We're not quite
Right.
at the place where a lot of people are imagining, and it's going to basically be a bit of I think they call it the trial of desperation, and then it's going to kind of
Right.
stabilize in a similar way to the internet, really, because obviously the dot-com bubble burst people were saying, this internet thing's just a fad, and
Right.
obviously, we know,
And
we
look
know,
what happened afterwards. Right.
right, exactly. So, absolutely, that makes a lot of sense. And now, this last headline is actually one I also shared on Twitter. I thought it was quite interesting. You talk about huge inflows to China ETFs from speculation about state buying. Kind of pretty interesting, wild idea there. Any thoughts?
Okay. I personally, I don't think it's speculation. I'm
Hmm.
pretty sure state is involved with pumping ETFs in
Hmm.
terms of at least pumping assets into it, just to boost the whole country's sentiment, right? Because
Hmm.
as like China right now, it's in a very downward spiral with a lot of their data in terms of from everything from import, export,
Hmm.
employment, inflation, everything is just going in a downward spiral right now, right? So in terms of, boosting the overall investor and also the country's sentiment, then yeah, would they put assets in ETFs just to make it look good? Sure. I mean, just yesterday, there's another headline that it's been confirmed where the government's been asked several investment funds in China to stop liquidating assets because they don't want too much assets been bleed
Right.
out the funds the country and whatnot.
Mhm.
Because a lot of foreign investors been rapidly like taking money out of the country already, right? I think today I saw somewhere. I think I think it's like Shanghai Stock Exchange where they're experiencing a ninth consecutive days where there's like assets from foreign traders that's been kind of redeeming and redeeming and redeeming and redeeming. So my thoughts on it, and in terms of in China, this is just me personally because from what I've seen, I've read in the past like decade. It's really not too far fetched where government gets involved in terms of just to maintain just to calm the market where they would tell investment funds, they would tell the market or traders or businesses to actually kind of comply in terms of the government's goals. So I really don't think it's much of a speculation and is really not too far
Mhm.
fetched. I think it actually seems pretty normal. That's something that Chinese government would do.
Right. Yeah. Absolutely. I mean, where do you draw the line? They might as well just start making up the GDP data as well, right? They could also do that.
Well, I think they actually did last year. I remember during their massive lockdown last year when a lot of people were criticizing how the whole world has been opened up already, but the economy is still in a
Hmm.
lockdown. And I think it was like I don't remember. I think it was like last summer where they had a GDP of like a 3% growth. And literally, I was looking at it. I was like, "How? Like the whole country's locked down. There's like no car moving, no oil, nothing, and your GDP still grew by 3%. Like how? Like how that came out of thin air? And
Right.
obviously, it's like a made up GDP. Again, it's not far fetched because this is just me being biased because I'm Chinese myself, and
Okay.
I've always been exposed since at a young age, like
Mhm.
in China, in terms of financial statements can be made up. A lot of stuff can be made up in that country, right? So again,
Mhm.
like the headline to me is that it doesn't seem too far fetched.
Right. Yeah, absolutely. Obviously, investing in Chinese stocks kind of, you could say, controversial. A lot of investors have been burned, but if the state is backing it, I mean, is there a trade to be made here? Is it a good time to buy Chinese stocks? I mean,
Okay, this is just my opinion on it, which is right now, sure, government would they're backing it. In the short term, would it come back up? Maybe, yeah. Who knows, right? Maybe in the next couple of months it might come back up. I mean, Alibaba, it's been like getting
mhm,
punished really hard in the past year. It's been kind of showing some signs of life. So
mhm,
in the near term, is it worthwhile? Sure. In the long term, when I say long term, I'm just talking about like the next like maybe even 4 or 5 years, right?
mhm,
A lot of believers sees like the whole revival story, whole economy. Oh, China, especially this year, right? Because they say, China, they reopened, the economy is going to, it's going to skyrocket because, they're going to start taking all these, like consume all these oils, all these businesses. And a lot of times, I think they're just looking at what happened in China in the last like decade and how fast it has grown, and they're picturing, oh, so that growth can actually repeat itself in the next decade. But
mhm.
I don't think that would be the case anymore, because I think China's also, at least at this moment, I think based on the data that I've seen, um, it's already been peaked or near peaked. It's similar to
Mhm.
how like Japan was actually the second largest
Right.
economy back in the 90s. I
Mhm,
really think China is kind of repeating the same history right now, in terms of, like, for example, population is declining over
mhm,
there. Investment, it's also declining from like foreign investment across the globe. It's been declining there. Um, so in the long term, I really don't think it can repeat the same growth that you see in the last 10
mhm.
years.
Right. Yeah, it makes a lot of sense. And like you say, definitely those that very good comparison with the population. I mean, is that I think they're saying that the population in China is just about peaked, right? It's going to start declining soon.
Oh, it's already decreasing, right? And then India already surpassed it.
Right, exactly. And speaking of which, then now I know that you mentioned at the beginning that you're pretty simple in terms of your investing, but looking ahead, long term, 5, 10 years, any particular areas that you're interested in, any sectors or geographies, and then to that extent also maybe any particular names you'd like to share with the audience.
Yeah, I'm so for myself. So when I first started building my own investments, I was obviously taught um, by the S&P 500, right? That's like the
Mhm,
very traditional way of investing. Just buy S&P 500, and don't look back when you have money. Just keep adding it. I have it myself too. But I actually have a lot more in tech, specifically in QQQ, the Nasdaq 100. I
mhm,
believe tech is going to be a main driver in the
mhm,
next decade or so for sure. Because back to my point earlier, if AI is going to be here to stay, tech is going to go up along with it. So
mhm,
personally, I favor tech over the typical S&P 500 broad base in the long run.
mhm,
Um, in terms of other allocation, I would put a little bit of dividends, like some, if you have some good dividend stocks, sure. I personally, JEPI, I'm not sure you're familiar with them, is the JP Morgan, the premium income. They have
okay.
a, yeah, so that's something I kind of hold on the side. It's just for income. It's like a
Mhm,
cover call strategy.
Right.
And then outside of US, I have a little bit of international, but more really towards the UK.
Okay.
I know UK's been taking a beating this year as
Hmm.
well, and also their inflation, their rate hikes and whatnot. But if I had to choose like a recovery story
Hmm.
between China and say the UK or Europe in
Right.
general,
Hmm.
I would probably put money in Europe versus China. I think Europe has a better potential, in the long run, at least uh, the next like 4 years or so in terms of like having a bit of a recovery because it's been lagging, the S&P 500 or the U.S. economy for a while already. And so
Hmm.
I think in terms of at least the next like midterm, I see some potential there. So I actually have a little bit of a European ETFs and equities in
Hmm.
my portfolio as well.
Absolutely, very interesting. Like you say, U.S. equities have definitely been outperforming the last decade, even longer. So,
Sure.
maybe it's time for international equities. That's something I've been talking about for a while now. To that extent, what about anything in the Southeast Asia kind of area, India, Singapore, Indonesia, those kind of areas which kind of promise a bit more high growth without
Right.
maybe kind of the problems associated to China?
Sure, sure. And this is actually something interesting I came across just a couple of weeks ago, which is emerging markets. So, as you mentioned, U.S. been leading in terms of growth for the past like over 10 years already, and emerging markets been kind of going by cycles. So if you look at the early 2000 to 2010, it did phenomenal. It actually outperformed the U.S. And up
Mm-hmm.
until like 2010 till like 2020, it's been underperforming huge big time, right? So there's this like side of the story where a lot of people believe, well, now's the time for emerging market to kind of come back in terms of growth, and that's how the cycle works. But personally, I think in terms of emerging markets, I would probably put my money in India specifically in terms of the
Hmm.
whole emerging markets, especially
Yeah.
from an say ETFs or fund point of view. Because if you
Hmm.
look at any ETFs in emerging markets, the biggest holding is always going to be China. China
Yeah.
is probably going to be like 40% of the entire emerging
Mhm.
market holdings
Yeah.
right now in terms of their allocation. So if you're going to buy emerging markets, I would probably just focus on India instead. One, because one, if you buy emerging markets, you're really just overly concentrated in China, which is I'm not in favor of. Two, a lot of people have been saying India is going to be the second China. I really do think India in the next like 10 years or so, it's really going to replace China to be the second strongest economy. In
Mhm.
terms of, you can see all these like factories, tech factories, have been kind of moving to India. So I see a lot of growth potential there. Population there, it's the largest right now in the world.
Mhm.
So yeah, I would say if you were to put money in Southeast Asia, emerging market, whatnot, I would just really just focus on India specifically myself.
Mhm. Absolutely, some good points there, and kind of agree with a lot of what you said there. So Thomas, I can't thank you enough for coming on. Before we log off, just so everyone know, once again, obviously you're on investorsnippets.com. Anywhere else people can find you on the internet?
Sure, yeah. So yeah, newsletter, investor snippets. You can also find me on Twitter. It's TLEE1228 at Twitter. I'm not pretty active on social, but besides that, then yeah, that's pretty much it.
Awesome. Well, once again, thank you so much for coming on, sharing your story, sharing your thoughts, and congrats on the newsletter. It's really great. I've been looking at it every day for the past few weeks, so thoroughly enjoying it, and hope we can do this again sometime.
Yeah, for sure. Thanks for having me.
All right, thanks for coming on, Thomas.
Thank you.
Thank you once again for listening to this conversation. If you're still around, I take it that you enjoyed it. So I'd like to once again remind you that you have the option to receive more of my content if you subscribe on Spotify. I do a weekly weekend video where I cover everything that's happened throughout the week, giving actionable investment ideas, covering the macro, looking at charts, and I put those out every weekend. You can subscribe directly on Spotify. Alternatively, you can also follow me on Substack. There's plenty of free content there, and for subscribers, there are also available the same weekly videos that I just mentioned, and also weekly macro newsletter. So around Tuesday, Wednesday, I also put out a macro newsletter where I write about everything that has happened, and again, investment ideas, technical analysis, and all that good stuff. So you can go ahead and check out my Substack on the description, and that's all. Thank you very much.